I think what the mistake people think is they have to buy a whole Bitcoin and come up with, $63,000. I mean, they can buy a Satoshi, a Satoshi every day, instead of a latte. And more importantly, if Bitcoin network value plays out in Bitcoin, yeah, let's take Urian's number, but let's say Bitcoin is 1 million. Okay, so it's a 20 times increase from here. Anyone who's long Bitcoin won't care about inflation, and that's the important thing, because it's really just the dollar getting cheaper. It's not, that's really what they're experiencing.
Natalie Brunell recently spoke with renowned financial analyst and Wall Street strategist Tom Lee. During the interview, Lee discussed his optimistic view on Bitcoin, wealth inequality, and how Bitcoin could solve various financial problems. According to Tom Lee, there are several factors other than fundamentals that influence prices in the short run, making it simpler to be confident in a longer-term price estimate for Bitcoin than a shorter-term one. He stated that using a combination of price-to-book and stock-to-flow methods, his company's head of digital strategy, Sean Farrell, has set a price estimate of $150,000 for Bitcoin by the end of the year. Lee explained that, with support from significant organizations like BlackRock, Bitcoin has evolved into a legitimate asset class. Rather than going all in, he advised investors to dedicate a tiny percentage of their portfolio, 2% or 5% to Bitcoin. Citing his firm's proposal to commit 1 to 2% to cryptocurrency, which has produced notable benefits for their clients, he pointed out that even a tiny investment can have a big impact. Tom Lee also emphasized how Bitcoin might develop into an affordable banking option, especially for people living outside of the US or in underprivileged areas. Because of its increased resilience and usefulness as a hedge against currencies and disasters, he thinks that Bitcoin's value might surpass that of above-ground gold, presently valued at $16 trillion. Watch clips from the interview for further insights into Tom Lee's conversation with Natalie Brunell. Please like this video, subscribe to the channel, and turn on post notifications for more content. Enjoy the video.
One, I would just point out, I think it's easier to have conviction on the longer term price than a shorter term. Because in the short term, there's a lot more factors beyond fundamentals that affect, a price of anything that trades on a market. And for instance, just recently, everything happening out of Germany and Mt. Gox is creating short-term headwinds and, potentially even breaking technical patterns, but it doesn't change where Bitcoin should be 5 years from now. But the price target of 150,000 is actually based on work from our head of digital strategy, Sean Farrell. And he's looking at a combination of his essentially what looks like a stock to flow model and a essential, like basically a price to book model. What is Bitcoin cost to produce, and what is that break even, and what multiple should you assign to that? And he triangulates to 150,000 roughly by the end of the year. And I think that's pretty achievable. It really principally only happens if the S&P actually can rally into the end of the year, and that's our base case. And, if someone's asking, why should they be interested in Bitcoin? So let's say you have some folks listening to this and are maybe curious, but they're not convinced they should own any. I think that question has already long been settled because, Bitcoin is now essentially a bona fide asset class. It has the backing of BlackRock, which is the largest asset manager in the world. Larry Fink even today was speaking post earnings about how important Bitcoin is to the future of BlackRock, and it's something that they're encouraging clients to adopt. I think that the mistake someone might make if they're interested in Bitcoin is thinking they have to go 100% of their portfolio into it. They only need to put 2% or 5%. And, if you think about someone sitting on cash, that's like 1 year's worth of interest on their portfolio. They just have to dedicate to crypto. We made that recommendation when we first wrote about Bitcoin, that they should put 1 to 2%. Today, if they didn't rebalance that recommendation, it's 80% of their total portfolio. So it's been a huge winner for our clients, and many have told us it's really changed their lives by making what they saw as a kind of a low risk bet, 2% allocation into crypto. And I think that's how people should look at it today, because Bitcoin isn't peaking. It's not that widely adopted yet. There's still so many skeptics, and there's many financial firms that are restricting their clients from having access to exchange versions of Bitcoin. So the ETF today is not even approved for many firms. And it tells me that there's still a lot of future holders of crypto.
How far can Bitcoin go?
Well, I think that maybe as sort of a minimum sort of target for Bitcoin, like, hey, when does Bitcoin have to reevaluate whether it's peaking is when the value of Bitcoin exceeds the value of above ground gold today. And that's 16 trillion. And the reason I think that's a fair benchmark is that, gold might have some industrial uses and it has jewelry uses, but the principal reason it's got 16 trillion of value is it's viewed as almost a singular hedge against currencies and against calamity. And to me, Bitcoin is far more resilient and useful if we were ever in a circumstance where you actually need to start using gold. I mean, if you try to, carry $1 million worth of gold, you probably need a couple friends to help carry that. You can carry $1 million of Bitcoin on a wallet.
In discussing Bitcoin's long-term prospects, Tom Lee mentioned a price target of $150,000 by year's end. He highlighted the robustness of Bitcoin and its potential to develop into an affordable banking system to persuade investors to put a tiny amount of their capital into it. According to Tom Lee, Bitcoin erases the distinction between money and social good. He pointed out that whereas Bitcoin pays those who keep and utilize it, traditional finance benefits stockholders from a company's success. Lee claims that this makes it difficult to distinguish between capital, equity, rewards, loyalty, and rent-seeking. Lee also said that, in the same way that airline miles are seen as money but not as actual currency, Bitcoin is upending the notion of money. In terms of the economy, Lee stated it is doing well despite the Fed's aggressive rate hikes intended to fight inflation. Recessions rarely happen when market participants anticipate one, he pointed out, and institutional investors generally agree that one is imminent. Lee countered that this would indicate that recessions are less likely due to popular anticipation. Lee agreed that there are indicators of a faltering economy, including dwindling excess reserves, a worsening labor market, and challenges in the housing sector. He did think, though, that since they are rate sensitive, they might go the other way if the Fed starts lowering rates. Lee also made the point that there is no evidence of a recession in the credit or bond markets, and there are no indications of a decline in the stock market. As such, he cautioned against using recession speculation as a strategy for investing. Let's go back to the interview and watch more clips to gain insights from Tom Lee.
I think Bitcoin's blurring, but even what the definition of money is, it's already blurred the definition of community benefiting from holding something. Because, in a traditional financial system, let's say you take Amazon and you have Amazon customers and they contributed to the growth and the fact that Amazon is one of the largest companies today. It's really the customers and the loyalty of the community of buyers and sellers. But the only people that benefited from that are actually the shareholders, the ones who actually provided the capital to Amazon. So it didn't create value for the community itself. Bitcoin is so different, right? Because Bitcoin is benefiting those who are actually holding it and using it. And that's why I think it is really blurring what an asset is, because it's blurring loyalty and rewards along with equity and capital and rent seeking. All these concepts together. So the idea that it's also blurring the definition of money, to me, makes sense. I'm oversimplifying it, but airline points are actually money, but we don't view it as currency, but actually it is money. In fact, there's a bill in Congress that potentially might eliminate interchange fees that credit card issuers can charge, and it would literally implode the value of all these hundreds of billions of dollars worth of airline points, which are essentially money in many people's minds. I'd understand why people are bearish, because the Fed essentially was planning to give the economy a heart attack by raising rates at the fastest pace ever to kill inflation, and how the economy fared was a secondary consideration. But here we are, more than a year after the last hike, and the economy's actually doing pretty well. So there's an expiration of the risk of a recession. And I've been following markets for more than 3 decades, believe it or not. And so I've experienced and covered many recessions. Recessions rarely happen when markets are all saying a recession is imminent. Markets participants aren't that smart. So the fact that so many people think a recession is imminent, and we see it. I mean, we do many meetings with clients, institutional investors, that view recession as their base case. I mean, that would just mean everyone suddenly is a great forecaster of the economy. And as you know, nobody can forecast the economy. We don't try to forecast the economy, but the only reason we think a recession is less likely is because everybody thinks a recession is likely. But logically, there are things weakening. I mean, I guess I'm not going to try to ignore it. We know consumers are running out of excess savings, and the job market is getting softer. And we know housing has become a very difficult market. It's unaffordable, and then there's parts of the country where there's huge rise in inventory. Durable goods spending, like on appliances and cars, I mean, it's absolutely tanking. I mean, used car prices are going to fall a lot. And there's an inventory correction. I mean, there's been a lot of destocking of excess goods inventory. Those are what's causing the slowdown. But the mistake I think anyone will make is to say, oh, well, that means this is going to lead to a recession. I mean, number one, housing, durable goods, and inventory are all extremely rate sensitive. So the minute the Fed starts cutting, all of those reverse. But second, the bond market, credit markets, corporate bond spreads, quality spreads, things that you think should be blowing out if there was a recession are absolutely mid-cycle. And look at the stock market. I mean, so I would say if someone is saying that they think a recession's imminent and they're bearish, they're shouting at the market. I mean, I don't know anyone who's made money trying to listen to an economist to bet on risk markets. It's really the wrong way to invest.
Meanwhile, analysts are increasingly optimistic about Bitcoin price potential after a recent rebound toward a critical resistance level that had limited gains earlier this week. Following a test of the 50-day simple moving average support around $63,500, Bitcoin surged past $67,000, according to CoinDesk data. It is now approaching a resistance line defined by the trend line connecting highs from March and April. This descending trend line has proven challenging to overcome, as seen on Monday and in May, making it a significant hurdle for bulls. Analysts suggest that this resistance might soon be surpassed. Key catalysts could include the U.S. Core Personal Consumption Expenditures, PCE price index, the Federal Reserve's preferred measure of inflation, set to be released at 12:30 UTC, 8:30 ET. The PCE reading is expected to show a 0.1% increase for June, following minimal change in May and 0.3% gains in the previous 3 months, according to FactSet. The annualized rate is forecasted at 2.4% for June, the smallest increase since 2021. Continued progress toward the Fed's 2% target could bolster the case for interest rate cuts, combined with resilient economic growth as indicated by Thursday's US GDP data. This could drive increased interest in risk assets, including cryptocurrencies. As we conclude, do you think Bitcoin will reach Tom Lee's predicted price target of $150,000 by the end of the year? How do you think Bitcoin's growing legitimacy and potential for mass adoption will impact the future of finance and investing? Please drop your thoughts in the comments below, share this video, and hit your thumbs on the like button. Thanks for watching. Don't forget to subscribe.